Okay, hi. So today I will be talking about the most fundamental, the most important financial indicators that you can use to evaluate any company, any stock, etc. They are the most fundamental ones and everybody uses them. They're just the most important thing to check and they are very easy to understand and to find. The first one is price to earnings ratio. We calculate that indicator by taking the price of the stock, in this case $100, and dividing that by the earnings for that year. So if the stock is worth $100 and earnings per one stock is $10, then the PE ratio would be 10 because we divide 100 by 10. And that means if the company's earnings stay the same, so there is no growth calculating into that indicator, if the earnings stay the same, we can expect to get our money back, to double our money in 10 years. In the next example, in the blue one, we have the price of 100 and earnings per year of $5. 100 divided by 5, that's 20. So we can expect to get our money back, to double our money in 20 years. And of course, we have to also add and look into the growth of the company, because maybe the price to earnings ratio is smaller or maybe it's larger depending on the growth. So if the company grows very rapidly, we can expect to pay bigger price for that company. So the PE ratio might be bigger. And if the company is a slow grower, the PE ratio might be lower. The next indicator is also very important. It's price to book value. So book value is the value of all of the equipment, building, cars, machines that the company possesses. So in here we have two examples. The red one, the book value is 1 million. So the car and the building is worth 1 million. But the market cap, so the price of all of the stocks of the company summed up together, the whole market valuation of that company is 2 million, meaning it's twice the real book value of that company. So the PB, the price to book value, would be 2 in this case. But in the case where the company has book value of 5 million and market cap is actually below book value, the market cap in this case also being 2 million, the PB ratio is 0.4. And that can sometimes happen, that the stock market, the market cap is lower than the real book value. And sometimes it can happen just because maybe the company has some problems, maybe there's some bankruptcy risk, or maybe the company is not generating any money. Maybe those buildings are just staying empty, not earning any money, not being worth really anything to those companies. So maybe that's why the price to book ratio is very low. But sometimes it can happen that the market is just very pessimistic and the price just goes low and low and low and lower and lower. And in this case, we can talk about anomaly that can give us a huge opportunity to earn money. Also, we can look more in depth into this indicator, like we could with the PE ratio. With the price to earnings ratio, we could look at growth and also add that into the equation. In here, we can look into the financial reports. Every company publishes them usually on their website, and we can read how they put things into the book value. Sometimes they use the cost of building. So if it costs them 1 million to build certain house, they will put it into the book value for 1 million, although the market value, the real market value, might be higher than 1 million. Also, maybe they bought some building 5 years ago or built that building 5 years ago. And 5 years ago, they built it for 1 million. And it stays in the book value at the same price. So it stays there for 1 million, although that building nowadays might be worth 3 million or 5 million. Maybe they bought some gold 10 years ago and they still didn't update the price. But that's like higher level of analyzing. This, what you can see here, is the most basic one. The next indicator are net profit margins. So the most important part of the company, of course, is being able to make money. And we want to see big margins. In this example, the company produces an apple for $1 and sells it for $1.5. So we get 50 cents of profit. So that's a very good margin. That margin is 33% because margin is calculated from the total revenue, in this case $1.45, so the price that the apple was sold for. How much of that is our net income? So net income of that is 50 cents. So 50 cents of $1.5, that's 33%. So that's our net profit margin. And in this example, the company doesn't pay taxes. So it's just selling for 1.2, earning 50 cents, and the net profit margin is 33%. And of course, as you can guess, the higher the net profit margin, the better for our company, especially during times of some crisis, of some depression, of economic downturn. The companies might have to fight harder for their consumers to keep selling the items. So they might fight using the price, so they might lower the price. So having greater margins make it possible for those companies to be profitable during times of recession, depression, or just economic downturn. And the last indicator is about debt. So we don't want to buy a company that's heavily in debt because it just makes them easier to go bankrupt. And when they do, you will probably lose everything. So in here we have debt ratio, which is just comparing total debt to total assets. So total assets are everything that the company has. So equipment, buildings, cars, etc. And debt is just debt. So in here, we have to divide the total debt by total assets. So if the assets is 2 million and the debt is 500,000, we would divide debt by assets, so 0.5 divided by 2, that would give us 0.25. And it's a debt ratio of 0.25, meaning that the debt is 25% of all of the assets. So 25% of the assets were bought using debt, or the debt is equal to 25% of the assets. And here, when analyzing debt, you can also go more in depth. Is this a short-term debt or is it a long-term debt? What's the interest? How much is the cost of the debt? How much are they paying for that debt? Because if the company is having 33% profit margins and they are only paying 5% in interest, it's a great opportunity to get more debt, and it can be a good debt that actually lets the company earn more. But if the interests are very high and are higher than the return on investment of that money, then it can be called bad debt. Okay, so those 4 indicators, they are the most important one. Let me summarize them. So price to earnings ratio compares the current stock price to the earnings of the last year of that company and gives us as an estimate in how many years we will double our money if the earnings stay the same. The price to book value, it compares the stock price to the value of all of the things that the company possesses, like buildings, machines, etc. The lower the price to book value, the better. If you have price to book value of 2, that means the market cap, the stock market capitalization is twice the real book value of the business. So the lower this indicator, the better. Then we have margins. So margins show us how much of all of the revenues are going to be converted into profit. So if we sell our products for $1.5 and 50 cents of that is our profit, then we have margins of 33%. And last one is debt ratio, where we divide total debt by total assets. And the answer, like in our example 0.25, that shows what percentage of all of the assets are financed by debt. So if the company has 2 million in assets, 0.5 million in debt, that means 25% of all of the assets are equal to debt. Okay, and I hope that will help you. Those indicators are not very in-depth, but they are the most basic and can be used to distinguish a very bad company from an okay company that is worth more time to investigate and to analyze. Okay, I wish you a great day. Thank you for listening. I hope it helped.